Hey everyone, this is June from Turning Point Life Investment, and I have Chris here with me.
Hi, everybody.
And this is your market analysis for August 9th, 2011. Chris, let's go ahead and lead us away.
Okay. Well, today we had a nice white candle. So it actually formed a piercing pattern, which is a bullish candlestick reversal signal. And that's basically where you have the first candle is a black candle. Who's in charge? The bears, the sellers. And then the white candle closes at least halfway into the black candle. And we see how there's a shift in momentum because all the traders that shorted on that black candle halfway to the close, they're now losing money today. And today we actually, with the very sharp move up, we have signs that some bottom pickers are coming into the market and short sellers were covering. So the people that shorted yesterday, they're a bit nervous right now. They're a bit cautious. And which leads me into the more important thing about bullish candlestick reversal patterns is that just like the hammer we had last week, and then today we have a piercing pattern, we need to get above today's high for bullish follow-through. Now with the piercing pattern, if we get above today's high for the bullish follow-through, then those people that shorted on the black candle yesterday are going to be losing money and most likely buy back their shorts. And then you combine that with bottom pickers and other people picking up stock, and we're going to get probably another sharp move up similar to today. Now, is that going to happen tomorrow? Possibility. But sometime this week we'll be expecting another nice rally up as long as you get some bullish follow-through. We can go into the hourly view. What I really like about the hourly view of today, if you look at the second to last candle on the right edge of the chart, you can see that it wrapped around the hour before that. A white candle wrapped around the black candle, which is a bullish engulf pattern, and it was confirming a support level. So we had a sign that the bulls are coming back in, especially with that long lower shadow. And then what happened to the bullish engulf pattern? It had follow through. Not only did it get above that high, but it actually rallied up so strong it broke above the 20-hour exponential moving average. If we take a look back at the 20-hour exponential moving average since its decline, it's been holding at some really good resistance level. And then today, since we have
Go.
well, since we have this white candle closing above the 20-hour exponential moving average, since that is a change in psychology, we're going to look for some more follow-through tomorrow, which is probably a move above today's high. I wouldn't be surprised for the market to get into that gap level. And if there's some more, a sharper rally, then we'll probably be seeing the market come up and test that 50-hour exponential moving average, which is really close to that $1,200 level, that century mark resistance.
Yeah, pretty much spot on. I see the same thing here. And the main thing we've all been talking about is the close above this 20-hour moving average. We've had sharp rallies before last week, a couple of times, but it never broke above that 20-hour moving average. And today you can see a shift, a change in that momentum. I also want to point out that this is a really good reversal sign right here. Notice how this is acting as support at 1120. We broke underneath it and it quickly came back up. So that was considered a fake breakdown. So anytime you have a pretty important level of support like around here where it held a couple of times and then you get a quick pierce and a rebound back above it, that I consider is a really good buyable rebound, or I mean a fake breakdown. And that goes the same with the upside as well. So today we got that reversal sign. So almost acting as a double bottom here on the hourly, double bottom right there. So again, you want to have follow through above today's high, just like Chris said, and that's the main thing, is follow through, right? No follow through here with this hammer, no follow through here with this doji, and who knows, maybe we'll hopefully third time's the charm, that we'll get that follow through today, not today, but tomorrow or something. But most likely, I think we will. I mean, today is a pretty significant day. We're up close to 5%, and that's going to attract a lot of buzz. It's going to attract a lot of media attention, and it's going to attract a lot of people to jump into this market. Even in the after hours, if we're looking at SPY, it's up almost $1. A lot different from what we've been experiencing, where the market's closed and the market's down another $1 or $2. So a shift in psychology is definitely in play here. Now this is definitely a change to the upside. The only thing is, how long will it last? You know, that's the only thing we don't know, is how long can this rebound last? Maybe another day or two. But for the most part, I feel like we can probably stay above this low area for the rest of this week. The other thing I want to mention is, if this is truly the bottom here, you also have to take time into perspective, because this came down really fast. So that means it's gonna take some time for it to kind of heal itself, right? For it to kind of just correct itself. It's really hard to say, or really hard to picture it rebound real fast and then come down sharp again. Absolutely it can, but when you get the sharp rebound or sharp sell-off, it kind of needs a few days, if not a week, for it to just kind of work itself, basically allow the bulls and the bears to kind of lick their wounds and figure out where to go next, especially given the new announcement with the FOMC. People are going to digest this new information and see where they want to take the market next. But overall, the current path of least resistance, intermediate term, is down, but short-term wise, it's probably going to be up for the next coming days. Okay.
Let's take a look at some stocks that I have on my watch list.
Sure.
First stock is NFLX. I think everyone knows what this ticker symbol is, Netflix. Nice. Yeah, I did break that trend line, so there's a change in trend, just like much of the market. But today it formed a bullish engulf pattern right there, and it's right under that prior support, now acting as resistance. Now, if Netflix can get above 240, I wouldn't be surprised for it to hit its first resistance level, which is around 250. So it's a quick trade, in and out, and you're basically playing a rebound and oversold bounce. You're not buying it because of the start of a new uptrend. So this is going to be a fast trade where you're just in and out. The other stock I want to take a look at is JOYG. And we can see that very nice white candle erased all of yesterday's selling. And I really want to see it get above today's high. And once it does that, then 82.50 is actually a pretty good target to the upside. I really think, or pretty sure that when this thing rebounds and moves up, it's probably going to hit 80. So I wouldn't be surprised to take some profits at 80 before rallies up to around 82.50 or so. Also for this, I'm going to have a quick stop, which is around $75.50. It's going to be a quick, fast stop for a big potential gain. Those are the stocks that I'm taking a look at. June, do you have any?
Yeah, maybe just a handful. I think, like you mentioned, with these type of recommendations, it's really just for a quick play, because a lot of these stocks have broken down. And for example, the one I'm going to mention is Ulta here, made a nice pullback towards a support area of around 50. Well, I guess every stock did make a pullback. But you want to look for stocks that are stronger than the market, or at least it rallied stronger than the market. Something like Ulta, Netflix, and you have to compare what's considered strong. Well, the market, this is the previous high of the market. It never closed above the previous high. But if you look at these other stocks, it completely engulfed, and that's why it's called a bullish engulf, or erased whatever happened yesterday. So I would much rather look for stocks like this, Netflix, and other stocks to play, because they are stronger, and it seems like it's attracting more buying pressure. But what I was saying is, these plays, they're basically going to rebound to resistance. If you look at the previous trend, it always used its moving average as support. Now that we have clearly broken underneath it, it's going to use that level moving average as resistance. So there's going to be a role reversal right there. So at most, probably at $60, 57.5, 60 is probably where I'm going to take this trade. Now here's the thing. Given all the buying that's been happening today and probably going into tomorrow, I wouldn't be surprised to see the market gap up. Just like how we always open with gap downs. And if the market gaps up, let's say, let me go back to the market here, to around the 120 area, I don't know if that's going to be a good time to be chasing because it's already been up, gapped up so much already, and especially given that 120 is where that 50-hour moving is going to be. So you really have to play by ear. If it gaps up too much and it looks like it might fade into that gap, then I'll probably stay away. But if that gap holds, then sure, you can buy it and probably put a stop underneath that gap. So it's going to be, you have to really manage these positions well. But if you don't want to play these rebounds, then definitely stay out. So anyway, going back here, Ulta is something that I recommend, that I like. TSCO, same thing, huge bearish engulf, or bullish engulf, right back to this resistance area. So above today's high, back up to resistance, or at least towards the moving average, 62.5, give or take, right around that area. And then last one here is MPEL. Also broke down, but not as badly as most other stocks. And a quick rebound here back to 13, give or take, would also be a good play for this type of stock. So again, right, we don't know how long this rebound is going to be or how sharp it's going to be, but you have to realize, given the extent of the downside, we could probably see a good rebound. At least my first target is around the 120 area right there. Let me go ahead and address something about credit spreads. We know that, like Chris mentioned, that he loves doing credit spreads, and especially given the high VIX we've been having. Where did you say you spread MA?
Yesterday I spread MA. I recommended actually 100 points away from where MA closed yesterday. It closed at 293, but let's say we're using 290 as an example. The 190, 185 you can get for August. This is like next Friday. You could have got about 30 cents, 25 cents. And it was just a spread so far out of the money that was just basically free money. Especially since it expires next week. It's just wow. So that's the way I like to do my credit spreads, is just super far out of the money and just collect that free money, and basically don't have to monitor it every day.
Yeah, and especially given the collapse in the VIX, a lot of the premium is gone. And another thing I want to mention is when it comes to credit spreads or naked puts or selling options in general, we have a few recommendations on our trade alerts to do our monthly income alerts, for example, on IBM, Google, stuff like that. And the main reason, anytime we issue a trade is, okay, there's a reason, there's an analysis for the reason why we enter a certain trade. And most of the time when we issue credit spreads, it's because of a high volume gap up. And our idea behind these issue is that it's going to stay above the gap. Normally it does. Normally in a normal, I guess, quote unquote, normal conditions, the gaps tend to hold very well, tend to hold up very well. But every now and then you get these market sell-off or pullbacks where it pulls even the strongest stocks down. And this time is no exception. And you can see here, once that gap closed, once the reason why we are issued the bull put spread is no longer valid, you should definitely get out, especially when we said the short strike is at 175. And once it breaks 175, that's a definitely closing time for this particular spread. And then also for Google, I think we said we issued at 540. It came back to close the gap. And if you haven't gotten out of the spread, I would definitely use this opportunity to either roll out the spreads or get out of them completely, because the trend seems like it wants to head lower. And I don't know, given another week and a half into this month of August, I'm not sure if it will hold above the strike price right here. I'm talking about Google specifically. So what I'm more concerned about is if it rebounds and then all of a sudden rolls over again, then your spreads are going to be in the money before expiration. So if we get another day or two's worth of rebound, I do suggest, I mean, something that I would consider is roll out, close out those bull put spreads, and maybe consider putting on some bear call spreads instead. All right, so that's really how I see when it comes to managing spreads or naked puts or whatever the case is. You still want to have a stop. Okay, your stop level is whatever your reason you got into this spread. Once it's wrong, you should get out, and that really applies to trading in general. Once you buy a stock, once it's no longer a reason for you to buy that stock, then you should definitely get out. Okay, anything else you want to add here, Chris?
No, that's about it.
Yeah, that really is it. An exciting day. It's never a dull moment when it comes to a bear market or a downtrend. I'm not going to say bear market just yet, but definitely the trend is heading lower. And like I mentioned, we will probably chop around, rally a bit around this area for this week. We just don't know how high it can go. But it really needs some time to relieve some of this oversold, stretched out conditions. So I expect tomorrow to be another exciting day. So, all right, then I guess we'll talk again on Thursday.